Good afternoon. Welcome to October. Welcome to Cup of Joe. I'm Mike Carrazzo, your host, and as always, I'm joined by Nick Webb. And Nick, we're about a few offices away from each other today.
You know, it's been a while since we've been able to do that, but yeah, it's good to be in the same vicinity as you.
Yeah, we thought about doing this together, but we thought it'd be a little hard to be in the same room together. Welcome.
Thank you very much.
We got a jam-packed show today. Later on in the show, we're going to be talking about nearshoring. We have a few guests from our Ryerson Advanced Processing team who are pleased to join us. Nearshoring for those, it's simply moving a process closer to home as opposed to offshoring. So we'll talk about the supply chain implications there, answer a few questions regarding quality, and of course, we'll take your questions along the way. As always, there's that Q&A button down there. Send in your questions for Nick, for our Ryerson Advanced Processing team once they get on. But Nick, before we dive in and before we give a hair update, I have one thing I need to get to. So in the world of market intelligence here, we consider Cup of Joe the master's course, right? Led by Professor Webb. But we're going to be taught. We also know that there's those that would need a basic understanding of metal. What it is, what do the alloys mean, what do the numbers mean. We're proud to host Metal 101, which is going to be happening on October 19th. It's going to be a live webinar just like this, 90 minutes. It's going to be led by, we have at least 10 supply chain professionals from our team chiming in, all lending their expertise. So if you're new to the buying role, you have someone on your team that's new or just needs a refresher course in metal, it's the place to be on October 19th. Starts at 2 p.m. Central. There's a link to register here. I'm going to drop it in the chat for everyone to have, but we'll also send it out afterwards with our recap. So live Q&A. It's going to be a good time. So definitely want to put that on your calendar. And over to you, Mr. Webb.
Awesome. We've got a lot to cover today, so hopefully we don't pack in too much for this next 1 hour segment. Before we hop into it, we always want to cover our safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, Tim Driver, and James Porter. This is not investment advice or anything like that, but we're going to give you the best and latest information that we can, and we hope you enjoy it, and hopefully that we get a lot of Q&A as well. First things first on the macro side, this is a chart that we have not discussed yet, but we've talked about the essence of this chart in prior Cup of Joes. I think it's a very important topic and it's pretty all-encompassing. What we're looking at, there's a lot within this chart, but I'll break down what we're ultimately seeing here. This is looking at the CapEx, which is capital expenditures of commodity producers. So commodities across energy, metals, and agriculture. And what we're looking at specifically is going to be North America, so US, Canadian Stock Exchange information. And what we're ultimately seeing is this is the amount of money that they're spending to further productive assets. So new mines, new oil fields, things like that. You can see that as we look back over the last decade, 2007, 2008, that was a big commodity bull cycle. 2011 to 2014, big commodity bull cycle. That would have been some of the times where we saw natural gas prices and crude oil prices up around the levels in which we are today. Now, what's interesting is from a capital expenditure standpoint, or said a different way, from an investment standpoint, commodity producers are spending far less money now on a relative basis than they were during those prior two commodity booms. Why is that important? Well, as we think about bottlenecks, shortages that we've ultimately seen over the last 2 years, it's looking like those risks are very much so going to be on the table as we roll forward through time. I'm not necessarily saying this is going to be a 6-month issue or a 12-month issue. This is probably going to be something that's far more structural, long-term, maybe 5 years, 10 years down the road. But certainly is a bit of an iceberg coming our way, because if we don't have companies and investment firms reinvesting in productive assets, whether it's copper for an energy or for a power grid, or grain for producing food, these things can eventually run out. And the shortages that we've seen over the last 2 years could continue to be more of a pervasive issue. So I thought this is a pretty interesting chart. It's not my own. It's of a company called Crescat Capital. But I thought it was a very good all-encompassing view across some of the topics that we've been discussing, which is really a lack of investment into the commodity production side of the equation. So until or unless this starts to turn higher, it looks like we might have some bumps down the road as we look forward several years into the future. Flipping over to the chart that I always like to reference, because I think it tells a great story from a lot of different angles, a manufacturing angle, a geopolitical angle. Again, we're looking top to bottom, alphabetical order, left to right, October 2021 through September of 2022. Very easily, you can quickly pick up that things are moving from deep green territory to yellow to red, seeing a lot more red in this month's PMI data. So that anything above 50 is going to be suggestive of growth. Anything below 50 is year-over-year weakness. A couple quick ones that I want to point out. Obviously, as you go down about 5 to 10 down, you're going to see the European region. A lot of the European regions are continuing to see softness. And some of those regions, the big major ones, France and Germany, have actually gone into red territory. So whatever we're experiencing here in the United States, it's certainly incrementally worse within Europe. One of the big reasons why I would say that's the case is due to lack of energy security. We've talked about that for a number of consecutive podcasts. Working our way down the list, I do want to provide a small semblance of optimism within the United States and North America. You look at the United States, 3 from the bottom, the PMI number came in at 52, which all things being equal is kind of a bright spot on a global basis. I would say that our energy security, while we do have inflation, it's certainly much more muted than some of the emerging market economies. And as I survey the landscape of our customer base, I would say that the outlook, at least for the next 6 to 12 months, still looks okay. It doesn't look phenomenal, but it looks okay. So on a relative basis, I would say it's certainly the case that the US is one of the bright spots as we look out over the global landscape. It is worth noting that China continues to struggle a bit. I continue to kind of kick this can down the road, which is I continue to think that it's more of a when, not an if, China lifts some of its zero COVID policies, but they just haven't done so yet. So they continue to struggle on that side of things. But the overarching theme here is keep in mind, some of my slides that are upcoming are going to look fairly negative, but I want to reinforce the statement that the US and North America generally on a relative basis looks okay for now.
Hey, Nick, I can't help but notice India. I know we mentioned it a few podcasts ago, episodes ago, I should say. It looks like it's remaining strong, and there was some significance there, if I recall, that you noted.
Yeah, and I think I got to be somewhat careful in this, but again, this is my personal opinion. It seems like there's a little bit of an element, and I love that we have Tim and James on, because we're going to be talking about not just nearshoring, but maybe even this concept of friend shoring, or the idea that some allegiances and allies are shifting. And I think that's certainly the case with India. And what I mean by that is India seems as though they're kind of an innocent bystanders, just kind of staying on the sidelines, not making a whole lot of noise through all of this fuss over the last 6 to 12 months. But there's certainly some evidence that they are somewhat of a beneficiary of the fact that as energy and commodities aren't going into Europe, perhaps there's an argument to be made that they're actually finding their way into India, and maybe even they're finding their way into India at a discounted price. So in the case of like Russian crude oil, if you're willing and able to go out and buy Russian crude oil, you can probably get it for $25 to $30 below the benchmark price. So this may be a situation whereby, India, being that quiet, innocent bystander, is actually getting some benefits of the turbulence that's happening in other parts of the world. So yeah, fair to point out, there's certainly the bright spot within the global manufacturing space. Continuing on to kind of broad economic indicators, this is one I don't believe we've looked at in the past, but this is called the Leading Economic Indicator Index. The blue line is going to be looking at it on a year-over-year basis. I apologize. The white line is looking at it on a year-over-year basis. The blue line is going to be looking at the last 6 months and then annualizing it. You can see at the blue line, so the last 6 months is inherently much weaker than the year-over-year data. And that's really just a suggestion that the last 6 months within the economy have been struggling more so than the prior 12-month period. It is worth noting that you can see that pretty visually as we go back to 2000. Anytime the leading economic indicator gets down into this type of price range, it has precluded or coincided with a recession. We go back to 2020, go back to 2008, 2009, and then the dot-com bubble. Each of these instances, we saw a recession. Now, I'm not trying to make the podcast about myself, but I continue to argue that we are perhaps already in a recessionary landscape, which is why I made the bet in the first place that I would cut my hair if and when we get an official recession. Unfortunately, my brother reminded me about a week ago. He said, I don't know why you made this bet, because the National Bureau of Economic Research typically doesn't even declare the recession until a year after it occurs. That, for instance, the last time we had a recession, it wasn't until a year after that they looked back at the situation and said, oh yeah, that situation back then, that was a recession. So unfortunately, it's not looking great for the haircutting in the next couple months, unless the Buckeyes slip up and fall to Penn State or Michigan. It's you might have to deal with this situation for a little while longer. I apologize.
I'm convinced you keep putting in these charts just to push it, so something will happen. So
I'm hoping somebody from that council is listening to Cup of Joe. I'm not sure we're getting to their ears though. So as we look at the current environment with regards to the Federal Reserve and their rate hiking cycle, I know we've talked about this in past Cup of Joes. One indicator that some hedge funds like to look at is the 2-year Treasury yield. We can see it here visually. When you compare the 2-year Treasury to the Fed funds rate, which is ultimately the rate that the Fed is trying to manage, and right now they're managing it higher, you can actually see that the 2-year Treasury tends to lead what the Federal Reserve ultimately does. You can see it on the way up, and you can actually see it on the way down as well, that the 2-year yield tends to be the leading indicator for where the Fed ultimately goes. Why is that important? Well, if we look at the spread right now between where the 2-year yield currently sits and where the Federal Reserve target rate is, it's about 100 basis points. And the idea there is the market is basically saying they believe Jay Powell and the central bankers are going to take interest rates another 100 basis points higher before they maybe pause or slow down or take some assessment of the economy. That's just a snapshot in time. That's basically what they're saying. But does the Fed ultimately get all the way up there? We'll have to see. There are beginning to be some cracks in the global economy, and I would say they are stemming by way of the hawkish Fed policy that's coming out of the United States. But one of the things that the Fed is probably excited about, which is a weird thing to be excited about, is the number of job openings that are currently out there. It's still extremely elevated, and you can see that here in this 5-year chart. It peaked out right around just below 12 million people. So again, there were only 6 million people looking for jobs. There were 12 million jobs open. The Fed didn't like that. They basically said the market is so insanely tight. People are still hiring in large quantities, which ultimately can drive wage inflation. We need to kind of damage the jobs market in order to calm down inflation, calm down wage inflation. And what we got this week was, for them, a bit of encouragement, which unfortunately is kind of bad news. About 1 million job openings have come off the docket. So we're now close to about 10 million job openings. It's still very elevated relative to history, but that move is certainly what the Fed is trying to achieve, is bring the number of job openings, bring the job market a little bit softer so that people feel a little less enthusiastic, stop spending money quite so much. So it's a little perverse what their goal ultimately is, but that's unfortunately the pain that they reference when they talk about trying to calm market conditions down. Now, as we think about interest rate hikes, I often get the question, I have gotten the question many times from colleagues where they say, all right, Nick, so the Fed's hiking interest rates, is that actually going to have a direct impact on the economy in a quick fashion? And my answer is typically, it depends on the end market. There are going to be certain end markets that are going to be much more quickly impacted by rate hikes. And there are going to be some markets, perhaps food, perhaps energy, that are going to be a little less sensitive to interest rate hikes. What we're looking at here, and I continue to just be kind of bewildered by this chart because it's sort of astounding. In a situation that we're in right now, where I would argue we have a slowing economy, perhaps recessionary type conditions, what we're looking at here is going to be the implied monthly mortgage cost if you're buying a home right now. And this is a 5-year chart. So ultimately, the math behind this chart is taking the average home price in the United States, which admittedly in the last 5 years has gone up pretty precipitously. And then secondarily, it's looking at the 30-year mortgage rate, which also has gone up very precipitously. If we look at the 30-year mortgage from a year ago, I would say we were probably sitting about 3% for a 30-year mortgage. That number is about 6.9% now. When you combine the fact that you've got more expensive homes and a higher mortgage rate, and you do the math on what the implied cost of financing that or servicing that debt would be, you can see that here in the chart. So in other words, to put it in layman's terms, if you were going to buy the average home in North America 1 year ago, your monthly payment would be, let's call it $750 to $800. That same monthly payment, if you buy that same house today, $1,765. That's more than a doubling of a monthly cost to buy a home. So I don't think it takes too much of an economics professor to state the obvious. This is going to impact the housing market in a very quick way. It's just getting very, very expensive. It's getting more expensive to own a home or buy a home in the face of what I would call recessionary conditions. That's a pretty difficult combo. So what does that ultimately mean? Well, here's a chart of buyers, basically prospective buyers for homes. This is coming from the North American Home Builders Association. This is pretty ugly data, and you can see in a very swift fashion the number of prospective buyers out there. The index surrounding that has cratered in the last several weeks and months, and that's just on the fact that it's gotten very, very expensive to do so, and we've got softer economic conditions in the face of all of that. So we're not down to the levels that we saw back in 2007, 2008, where we had a real financial crisis and a real housing crisis, but we're not too far from it. And given the trajectory that we're currently on, it doesn't take too many more data prints to get down into that type of price range. So I'm not trying to paint a picture of sky is falling, because we've obviously seen very big inflationary moves in house prices. So people who have already bought a house, even though prices may be coming down a bit right now, they're still feeling pretty darn good if they bought the house more than a year ago. For those who bought a house in the last year, yeah, they might be starting to sweat a bit. But yeah, if anybody here on Cup of Joe knows a real estate broker, give them a call, maybe buy them a bottle of wine, because it looks like it's probably going to be a tough go of it for selling homes in the coming months. Now, what does this ultimately mean for inflation? It's a very peculiar thing, because I didn't know this till this week. The CPI in no way, shape, or form actually reflects home values or mortgage values. What it instead tracks is owner's equivalent rent, which is, let's just call it rents. Unfortunately, what this ultimately means, with the fact that it's getting more and more expensive to buy a home and have a mortgage on a home, it means that more people are going to be renting. And if more people are renting, the demand for renting is up. Thus, you probably have a stickier rent situation. And unfortunately, rent makes up about 40% of the core inflation rate. So some of that pesky inflation that the Fed's trying to get under control, in a weird roundabout way, the stickiness of the rent market is actually going to continue to cause issues probably for central bankers in months ahead.
Not to state the obvious there, right? But as home buyers are disappearing, then you subsequently have, they're not buying appliances, they're not buying this, they're not buying that, right? So it further contributes to, going back to how does that impact the economy, right? It's a trickle effect, if you will.
Yeah, there's certainly a knock-on effect. And I'll sort of talk out of both sides of my mouth on that one. On one hand, yes, if you're buying a new home, typically you're going to furnish it with arguably new furniture, appliances, things like that. So certainly that end of the market would take a hit. Alternatively, though, if you take existing homeowners and they were let's say maybe 6 months ago, they were contemplating moving into a new house. If they're all of a sudden getting word that they should not move because that new mortgage is going to be double where they locked in 3 years ago, there's this idea that they'll ultimately stay in their existing home and perhaps do some remodeling. So you might get a little bit of a tailwind on, okay, I'm not going to move, I'm going to stay in my home and remodel it. You could get a little element of positivity there. So ultimately, one of the big wrecking balls, I think we talked about it last month, is the US dollar. We looked at it last month, looking at the USD relative to the euro. What this is ultimately looking at is very similar, but it's looking at the US dollar strength relative to a basket of currencies. The biggest contributor to that basket within this index is still the euro, but it's looking at a variety of other currencies as well. But you can see pretty clearly since mid-2021, as the Fed has gotten more hawkish, as we've taken interest rates higher, and as the US tends to be kind of the bright spot in the global economy still, or one of the main bright spots, the US dollar has been a very attractive thing to own. And as many of you may know, as the dollar strengthens, it tends to act as a headwind to the price of commodities. And we've certainly seen that in the last, I'd say 6-8 months. Things like crude oil coming back down to about $82 a barrel, aluminum coming down by 50%, steel coming down by 50%. Some of the contributing factors around that, yes, you've got supply demand that's more normalized now, but you also have a strengthening US dollar, which is weighing on the price of commodities. So this is something that maybe isn't discussed all that much within financial news networks, but the dollar strength is certainly aiding for our customers cheaper commodity prices, at least thus far. And then before I kick it over to Tim and James, I want to touch on the oil situation, or sorry, more broadly, the energy situation, because there's a lot going on here. I guess the very high level theme is many of the energy issues that we've talked about in the last, I'd say, year, they still exist. Yes, some of them have come off their highs. We've seen oil come down from 125 down to 85. We've seen natural gas go from 10 to 750 here in the US. But many of the supply demand issues are very much so still afoot. So all of the things we discussed with regards to lack of energy security in Europe, they still exist. Even though prices have come down somewhat materially, they're very elevated relative to long-term histories. Here on the slide here, what I have is a chart of the Strategic Petroleum Reserve here for the United States. So this is ultimately a reserve of oil that was put in place for arguably military-esque times, basically emergency type situations. For the last year, roughly, the US administration has decided that in order to better supply markets for geopolitical reasons and for just bringing the price of energy down, making it easier for consumers, they made the decision they're going to release large quantities of oil. Specifically, it was about 1 million barrels per day for the last 6 months. And you can see this is a very long-term chart going back to the early 1980s. Very, very quickly, we are draining this strategic reserve. Now, I won't debate whether or not it's a good idea, bad idea, or whatever, but it is certainly something that the US has decided to do to better balance supply-demand conditions for energy. Fast forward to this week, OPEC, the oil-producing regions, they had a meeting where they decided to cut oil production by 2 million barrels per day. So double what we've been draining out of the SPR. That, I don't want to get too deep into politics, but it certainly goes in the face of the strategy that the United States has had for the last 6 months, which was better supply the market, use kind of every mechanism we have to try and get more oil out there in the economy. OPEC is going, admittedly, the opposite way on that. So this week we saw that take place, and then almost, literally within minutes, the U.S. administration came out. They acknowledged their distaste for those actions, and subsequently, the president said he's going to further draw down 10 million barrels of additional Strategic Petroleum Reserve oil in the next month. Is some of that politically motivated? Maybe, but that's the retaliation to the OPEC move. Fast forwarding one more step, there are rumors, or there have been rumors in the last 24 hours, not verified at this stage, but it's kind of crazy the headlines that are coming out there, which is the United States was even contemplating lifting sanctions on Venezuela to get Venezuelan crude oil out into the global markets. Now, why is that a big deal? It flies very much so in the face of what we've historically thought about Venezuela as an ally. And I'm ultimately trying to segue this into to Tim and James here in talking about nearshoring, friendshoring, things like that. Because the point of this is whether or not we lift sanctions on Venezuela to get more energy out into the world, there is certainly a situation whereby the puzzle pieces of the world are very much so in a state of flux right now. The people we thought were friends are maybe less so friends. People who didn't used to be friends are now becoming friends. And the allegiances are certainly aligning as we sit here today. I don't want to pretend as if I'm a military expert or a geopolitical expert. I am not. But if you're reading the headlines and seeing what's happening, there are certainly some shifts in the way people are working with one another. I think it's really timely that we have Tim and James on the call today, because some of what they're going to talk about is in essence what I just referred to, which is a lot of supply chains are also rejiggering the way they look at supply chains and how they want to get material, where they want to get it from, who do they want to cozy up with, do they want to keep it all domestic? So with that very long-winded introduction, I hope that was a decent transition. I'm going to kick it over to James Porter, who is part of our Ryerson Advanced Processing Division. So they're doing a lot of high-end fabrication for us, and they're going to talk about nearshoring, friendshoring, and all the things related to that. So James, go ahead and kick us off.
Thanks, Nick. And I want to address a couple of things. First of all, on the inflationary hair challenge, when you do cut it, are you going full Mike Carrazzo when you cut it? Like I need some detail there.
I think the devil's going to be in the details, James, because if I can get my hair, if my hair gets beyond, I don't know if it's 12 or 14 inches, and I can get something to locks of love, maybe I'll go that route.
Well, thanks for joining us, James. That was a very short segment.
No problem. And then I'll jump back to your manufacturing chart you started with. I couldn't help but notice that Canada, Mexico, and the US all bumped up at the same time from August to September. And I think really that kind of encompasses what nearshoring is, okay? It's getting back to supply chain options and really looking for a durable supply chain. And our customers, our supply chain network, partners, our mill partners, everybody's looking for what is the right option to make my supply chain as durable as possible. And I equate it to, going to the store to buy a gallon of milk. When you go to the store, you usually buy 1 gallon. You're not going to buy 3 months worth of milk. You don't have the storage at home to take 3 months of milk. You've got to load and unload it. And it's the same thing with our products, whether they're fabrication or general line, right? Everybody's looking to narrow down and streamline their supply chain to reduce those soft costs of managing inventory, of counting it, tracking it, of the effort it takes to forecast 3 to 6 months out. When, as you just showed, Nick, in numerous slides, the market is definitely taking a turn. Do we know which way it's going to go? Not completely. The manufacturing index kicking up from August to September, I thought was a wonderful bright spot, right? And I think it's how we, as a company, and everybody who's involved in manufacturing really deal with and put a lot of emphasis on, a dynamic, durable supply chain. And I'll throw a topic to Tim. So one of the things on the topic is, sure, when you nearshore it, I should be able to get it faster. I should be able to have more options, right? But we all know that headcount in North America is an issue, right? Maybe not so much in Mexico or Canada as in the US, but through automation and other methods, we are finding that we can come up with supply chain solutions to make nearshoring a much more viable option, and to keep more cash in your pocket and more space on your floor to actually make your product. And quality is really the first thing that I believe needs to be addressed when you talk about nearshoring your products. So you're used to your supply chain. When you nearshore it and you go with a different option, what's that quality going to look like? So Tim has spent a lot of time in North America traveling, both internally with our plant and with our supply chain partners. So Tim, if you would kind of give us what you're seeing on the quality side.
Yeah, James, thanks for that feed there. And Nick, real quick, just want to say one thing from down here near Athens, Georgia. Go Dogs.
Awful.
We'll go with that.
You guys had a tight one with Mizzou. I don't know.
I know, but the end result last year still speaks for itself. So we'll go with that.
Touche.
Anyway, the supply chain here for fabrication shops is very different than it's been the past, let's say even 10 years ago. The past 2.5 years have really shown quite a disruption in what the methodology is for outsourcing, especially to the Far East and Asia. Typically, it wasn't that hard of a decision. It was cost and cost and cost, and that was it. If you had a quality problem, you still were ahead because the cost was so, your landed costs were cheaper than the material used to make the product. But manufacturers, OEMs that I'm talking to, and fabrication shops that I've been seeing as I travel got singed a little bit in the past couple two years, and got their eyes open to that. The world isn't quite as stable as it used to be. That things can pop up very quickly in this kind of a political world that they weren't seeing. And we had supply chain disruptions at the ports that they had never seen before. We had entire ports in Far Eastern countries that were shut down for a month. Thousands of ships sitting out in the water. So as a result of that, there's a lot of interest in bringing product back into a neighboring country or a more friendly country, as we're saying. And shops are filling up. I know American fabrication shops now are very busy. Everywhere I go, they are seeing a lot of work coming in. They're seeing work come back that they lost years ago. South of the border in a neighboring nearshoring country, we're seeing a big uptick in product that they've lost years ago that is coming back as well. Most of that kind of product is product that is not hard to transfer. So 1, 2, 3-stage processing, we're not talking about assemblies, we're just talking about individual parts. We're seeing come back from overseas because that makes it easy to move back, and they are pulling the trigger and moving it back.
I got a question for you, or James. Yeah. It's easy to talk in hypotheticals about more durable supply chains, bringing things back towards more North American production. Let's get to the reality of it. How long is the duration from when a company, on average, or given the instances you've seen, they decide they want to take an effort to doing this? How long from start to finish do you think that process actually takes? If they started it today, is that something that could be a 2023 outcome, or is it longer than that?
Yeah, I think there could be immediate wins. And I think that's, at Ryerson with our numerous branches and supply chains, I think that the hardest part for the customers that I've seen this year is the dynamic transfer to, I've had a stable supply chain, and now that it's not stable and I have to come up or create that durable supply chain, that knowledge is hard to come by. It's not just sitting there in a Rolodex for, hey, I need to find how to make part ABC now and I want to make it closer. To go out there and create that network of suppliers and vendors is a very hard thing to do, right? So I think what we offer and what we've had success with this year is that is exactly our goal is, and we have seen this coming. So for the past 4 or 5 years, we've created that partner network along with our branches, along with our general line feedstock, that we can move pretty agilely to help a customer do that sooner than later. Now, outside of what can we do locally or within North America, I think, Tim, as far as how long it's really taking when you deal with Asia or India for that matter, and you pull that over, I think you have some experience in the area. What's that time frame from when that boat leaves to when it actually shows up that you're going to have to deal with as a customer?
Yeah, and it does vary, James. Typically, when you're pulling product in from that far away, you have 6 weeks on the water. You have 2 or 3 months of inventory here domestically that you already have built up, and then you may have 6 or 8 weeks of lead time involved with the supplier over there. So it can be anywhere from a couple months to 6 months to reshore something back on on this side of the ocean. And the problem OEMs are running into is the people who outsourced the parts years ago overseas are now gone. Those people have moved on to different things. The people that are in place now do not have a network of nearshored suppliers that they can just pick up the phone and call and say, hey, I'm bringing this part back. Can you start making it again? That's gone. So this is where our network that we put together is showing some real promise in addressing this situation. We have a network that we can call on across the entire country and down into Mexico, and we deal with all the time, and that is going to help resource a lot of this product.
Tim, how do you ensure the quality on that, right? I mean, James, you talk a lot about the durable supply chain, and what you talked to before is this matter of quality. Now that you're dealing with parts of the supply chain you haven't dealt with before, how do you ensure that that you have that insurance on they're going to produce it to your quality standards?
So we have the shops in our network. We have vetted and have categorized into different quality levels. So we have general fabrication, medium level fabrication, then high tolerance certified fabrication. So as we get requests from various potential customers, we look at what their quality needs are, and then we source it to a shop that meets their quality needs, but they do not wind up paying for quality that they don't need for their particular product. It gives us a lot of flexibility in how we arrange supply chains.
So coming back to something that James had touched on, but I want to expand on a little bit more. One of the hurdles, it seems to me, given the fact that labor markets, and more specifically labor markets within manufacturing communities, are incredibly tight. I know that Ryerson's got many job openings that we just haven't filled for a long time. Many of our customers are in that same situation. As you work more towards reshoring, bringing things back to North America or America specifically, labor seems like it could be an issue. How do we, or how does the industry foresee circumventing or getting around that issue?
And Nick, that's a great question. I think we could almost have another Cup of Joe segment on that, and that word is automation. We are automating everything we can, right, to ensure that we can do things agilely and with the right quality. We have a new facility coming online in Centralia, Washington, that has new automation added to it that we haven't done in the past at any location. It can load and unload a 96-240 of plasma, oxy, or laser cut parts all at once. And those type of options, along with another facility we're going to add with robotic press brake capability, as well as laser cutting, loading and unloading, and will actually start to palletize. And that particular subject of palletizing parts, I think, is a real area in which internally at Ryerson and with our supply base, I think that really starts to change the game on how many hands you need to really get your product out the door. And we're seeing that everywhere. I mean, everyone understands that is a lever we're going to have to pull if we're going to keep product nearshored, if we're going to stay competitive, and if we're going to deliver on time.
Yeah, James, as I travel around, the fabrication shops are investing heavily in automation. They are looking at the labor market, and it's universally the question. The universal answer is yes, we need more people, but we can't find them. This is a problem across the nation, and they are investing heavily in automation because they do not see an end in sight for this labor problem. So there's a lot of investment on order. Lead times are going out on equipment because there is so much being purchased right now, along with other supply chain issues. But as you go from supplier to supplier, they're quick to tell you, hey, I ordered this, I got this one's on the way in 6 months. And just a lot of automation coming in because they know they have to do that. But then, in our network, we do have south of the border labor, which is not as constrained as what we have here in the U.S.
Good point.
So we are going to continually look at resourcing to companies south of the border that have the labor as it's appropriate.
Question from the audience, guys. You mentioned first, second, third fab, but not full assembly or heavy fab assembly. What are you seeing in that realm?
So the issue there is we can do it, right? And we have had success in doing it this year. It's more about taking the time to make sure that when you talk a full assembly, you have a lot of things that come into play there, and that is how that assembly is going to connect to the further product that you're creating, right? Whether that's, a vehicle or, vacuum systems, you name it, right? So it tends to lengthen the lead time, right? If you want to do it right. And at Ryerson, we're not as concerned with, hey, here's an opportunity, let's get started right now, let's push it. We want to make sure that it's correct, that it's delivered on time, and the quality is where it needs to be. And a lot of these companies, right, are doing this for the first time. They've never said, hey, let's take this entire line that we've been receiving from a far shored supplier, and we're going to change that totally, right? So when you do that, there's a lot of conversation about how assemblies, and it could be that they're painted, it could be that they're anodized. There's lots of little things that come into play that we want to make sure we take our time and do. So I think to Tim's point, the first three are very quick to be done. We can move very quickly. When you go to full assembly, it's not that we can't do it. We want to do it. We were successful at doing it. We just want to take the time to make sure that the customer's product is handled professionally and correctly. And we take that manufacturing at RAP, Ryerson Advanced Processing, very seriously. We don't want to disrupt a supply chain by trying to move a complicated part too quickly. We want to make sure that, as durable as that may be, that it also sticks, and that supply chain can be relied on from now on, and that the customer can go back to engineering their parts and assembling it and selling their product, and worry much less about how many gallons of milk they're going to go buy at the store.
Yeah, great point. Here's another question from the audience, and this really speaks to the conversations about energy costs kind of being the headwind versus the ability to get things quicker via transit. Is the partner network starting to yield faster turnaround times for various alloys? And I think that's speaking to, is it more on the ability to get something versus the energy cost to produce the alloys? So is the partner network fielding any faster results there?
I think in North America it is. We haven't seen energy costs or the inability to get a certain metal or chemistry within the metal. As far as in North America, we haven't seen that get in the way this year whatsoever. Obviously, you could say the cost of gas and diesel have gotten away. So you could say that energy cost has been one that has affected how far most of our customers or supply chain or suppliers are willing to look in their geography. And I would say that most of the successes I've seen this year are when those norms are actually broken. Because when you look a little further than your normal geography, you're going to find, whether it's our internal branches capability, or again, with our supply chain network, you're going to find that they're better at certain things. And when you find that scale of automation or expertise that you can leverage, freight becomes less of an issue. If that person has a newer machine, or we have the automation we're adding internally at Ryerson, and you can do things faster in more bulk and ship it, you can get through some of those energy costs. And I've been excited in manufacturing the past few years to see the shift in nearshore. I believe that as a group in North America in general, I see a lot of gelling when it comes to how we, as a nearshored continent, can really do these things. And I think that everyone's paying attention to the challenges. I think there's effort from top to bottom, and it's been successful this year, and I think that is going to continue. So I think we're making it through that one, to be honest, on the energy side.
And the questions are starting to pile up here. So we got a lot waiting for you here. So Nick, maybe before we get into those, let's go into your metals overview and we can get to the questions.
Yeah, no, appreciate it. And so, yeah, Tim and James, sit tight with us. I'll go through the three metals and then we'll come back for final Q&A. But want to make sure we touch on why we're all here, which is to talk about the metals industry. So specifically on individual metals, first, I want to talk about aluminum. This is a one-year chart, similar to what we've shown in the past. Down below, I've got the relative strength index, which is basically a gauge of whether things are oversold, overbought. You can see that in the last couple of weeks, we actually did get into pretty severe oversold conditions, which, all things being equal, can act as one of the indicators that might cause people to step in and start buying some contracts. And it looks like that's actually what's happened in the last couple of weeks. Something specifically, though, not just from a technical chart standpoint, happened as well, which was news started to proliferate from the London Metal Exchange, which is where a lot of these products are traded, that the LME is considering, and maybe they've been considering for a long time, but it was just put into the press that the LME is considering banning Russian material on the exchange. Now, why is that an issue? Russia is a very big player in aluminum. Russia is a very big player in nickel. And if the exchange bans that product on the exchange system, well, all of a sudden the available inventories on that exchange gets even leaner than what it already is, which admittedly in the case of aluminum and in the case of nickel, inventories on the exchange are actually already pretty lean. So you can see that potentially coincided with when we saw this rally actually take place in the last couple of days. I think the other thing that's taking place within the aluminum market is shown here. We've talked about this in prior couple of Joes, but this is ultimately looking at the cost curve, or said a different way, the cost to smelt aluminum. As many of you probably know, aluminum is extremely energy intensive. So as natural gas prices, coal prices, electricity prices go higher and higher, it becomes more and more difficult for a smelter to make aluminum profitably. And the last time we hopped on this call, I put this blue dot where the prevailing price at the time was, which was actually further up in this area. We've got to shift it down and to the left because the price of aluminum now, relative to a month ago or several months ago, is getting cheaper. So what that means is fewer and fewer smelters are able to produce aluminum profitably in this environment. If we went back to the lows of a week or two ago, where prices actually got below $1 per pound, you're talking about working your way all the way down in this area where you've probably got 60, 70% of aluminum smelters that were not making money for a period of time. What happens when you can't make aluminum as a smelter? You eventually shut in production. And we're seeing some headlines of European aluminum smelters doing exactly that. And I think more are probably at risk of doing that if in the event energy prices stay high and aluminum prices stay low. So this is a risk we certainly want to keep an eye on. I personally, my personal opinion is that I think that probably limits how low we can ultimately go on the price of aluminum, because the deeper and deeper we go, the more aluminum producers get unprofitable, and then they shut in production, and then all of a sudden supply demand conditions balance out or ultimately get very tight and prices go back up. So I think we're seeing a little bit of that playing out. I'm not here to say we already saw the bottom or anything. I think we're obviously going to see some turbulence here in the coming months, but I think that factor is certainly playing a role as we've seen prices start to stabilize. On the aluminum side for Midwest premiums, it seems like every single day we open up, our pricing sheets, Midwest premiums are headed lower. One of the big reasons for that is because the logistical networks of getting aluminum into the Midwestern part of the United States is getting easier. Freight rates are coming down, at least for now. Demand for flatbed trucks and trucks in general is loosening up. So that's aiding the fact that premiums are heading in that same direction. Looking at the price of carbon sheet, not too much new to report here. There is one thing I do want to touch on, but ultimately the spreads between US and European and Chinese steel, they've converged back to more normalized ranges. I would say we're getting into a comfortable range, and the momentum to the downside certainly appears to be waning with US prices. Now, that being said, the one caveat to all of that is scrap prices haven't yet really found a bottom. It seems like every single month we think they're going to stabilize. We think scrap prices on a month-over-month basis are going to be flat, maybe even slightly up. But we continue to come in each month and scrap prices are softening. And what that ultimately does is it makes electric arc furnaces ability to produce steel profitably, it just lowers that floor. So if we take, again, the math that we've historically done where we take scrap plus $300, that floor perhaps is a little lower than where the current futures market is. Current futures are trading in the high 700s. Right now, if you take scrap plus 300, it's in the low 700s. Does that mean we're going to head to the low 700s? It doesn't have to, but that's kind of the fair value given where the cost of raw materials are ultimately. One thing that the mills are attempting to do to counteract that, however, is capacity utilization. So this is basically looking at the available productive capacity of US steel mills and looking at how many of them are actually producing at that rate. And you can see that production capacity is coming down, meaning mills are being taken offline or they aren't being restarted after getting some maintenance done to them. That is occurring. So some of the things we're seeing in aluminum, where aluminum smelters are taking things offline because they're not profitable. Well, steel mills are doing a little bit of the same thing. And in the last week and a half, we got news that Mon Valley is actually post-maintenance deciding not to reopen for some indefinite period of time. Eventually, maybe they'll bring it back online, but that is aiding the fact that capacity utilization is in the low 70s at this stage. Or I apologize, high 70s, below 80%. And then a couple months ago, we had Brian Crane in to talk about plate prices. And I think we were both kind of pounding the table saying the spread between hot roll coil and plate made no sense. I still contend that the spread is probably a bit exorbitant, and I think it's beginning to correct at this stage. So in the last month, I pulled up this chart from a month ago, and steel plate prices were about $130, $140 higher than where we are today. We got a price decrease announcement from a number of the domestic plate mills. And I think that's really just an indication that even they know prices were too high relative to the rest of the carbon complex. So if I'm pulling out my crystal ball, I expect this spread, which currently is about $850, to continue to dwindle lower. And then lastly, on the stainless steel side of things, stainless and more specifically nickel has had an interesting 30 days where at the beginning of September, nickel prices experienced a pretty big rally. I think it was about 25%, where it went from low $9 per pound all the way up to $11.50, kind of bumped into the 200-day moving average, which you can see shown here in the yellow line, and it failed to break through it. So it failed to really gain real material momentum just yet. And since then, it's faded back down into the $10 per pound range. It remains to be the case that this investigation into Russian material is going to be applicable to nickel as well. And you can bet that if Russian nickel is also banned from the exchange, that would further tighten what's already a fairly tight refined nickel market on the exchange. So I don't think the fundamentals, barring that situation, really suggest we have a real big upside catalyst within nickel or more broadly stainless. But something like that could certainly cause a jolt within nickel prices if it were to take place. Looking at the technical side of things, the relative strength index down below, kind of in the middle ground territory. So I wouldn't say from a price direction standpoint, there's really any compelling evidence that we need to break massively lower or higher at this stage. What did break in one particular direction was the price of chrome. Chrome isn't something we're always talking about here on Cup of Joe or within Ryerson, but certainly on a quarter-over-quarter basis, we saw a fairly large reset where chrome prices reset down by 31 cents per pound, which is almost 20% of where the price previously was. So expect that to feed through to lower surcharges as we roll into Q4 and the beginning of Q1. A lot of that's really just on the back of supply chains beginning to loosen up, most specifically within South Africa, where the bulk of chrome is produced. So anything related to flooding or COVID or the supply chain issues, they seem to be, for the most part, behind us. And with that, you can see chrome prices are getting back into a more normalized range relative to what we've seen in the past.